Welcome back. You're watching Stockwatch with me, Juliette Televi, standing in for Zanati this evening. Joining me to take your stock-related questions tonight are Alex Duys from Umthombo Wealth and Roy Mutooni from Sanlam Investments. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Alex, Roy, good evening to you both. Roy, if I may start with you tonight. I was just saying to both of you before we went on air, it's quite, and I said this again last night, so I'm keen to get your views. It's quite weird to have the set of circumstances that we're experiencing in the market all at once. You've got the rand again strengthening today. You've got gold price at $2,349 an ounce. Yet you still have an expectation of fewer rate cuts in the US, and you've got commodities running. Is this a bit of a bizarre set of circumstances that we are actually experiencing at the moment?
Juliette, yes, it's actually a very unique environment, and maybe there's a couple of ways of explaining it. I think, first of all, you start with the thing that's really big. It's around gold, and you can see that gold shouldn't be rallying when interest rates, long-term rates are rising in this way. But I think the whole point here is that in all likelihood, right now, what we're seeing is a change in narrative. Up until now, it's all been, are we in a soft landing environment? Is there a recession coming? How many interest rate cuts? But what the data is showing, if you try and look through all the tea leaves and try and get it all together, is first of all, global PMIs are recovering. So we're past 50. So it looks like you're seeing global economy beginning to turn, whether it's China, the US, it's only Europe that probably isn't. So we're no longer talking about a soft or hard landing. What you're talking about is a global recovery. Then gold reflects all of this being very schizophrenic. So gold could be a currency, could be a commodity, it could be a safe haven, could be a store of value. And you're seeing each of these faces showing up right now. So geopolitics pushes the price up. The fact that inflation is sticky pushes the price up as well. And then you go to the yields. The yields are sticking up there because it feels like economy has started going up and the economy is stronger. So long-term yields become a whole lot stronger. So you put all of those things together and you get this very confusing mesh of economic situations. Now what we're waiting for is to see what the dominant one is. And I guess one of the indications we're going to get is from the CPI print today.
Alex, I mean, if you had to figure out what the dominance theme will be, or the outcome maybe this year, would you be willing to hang your hat on anything?
To give more color on the gold. I mean, gold is an asset that tends to be traded on emotion rather than rational thought. So, and as a result, you do get this type of momentum in gold. So when things do really go well for it, it can go a lot higher than you think it can. And then eventually it fades out. And this tends to be the case over a number of periods of time. Just look at any gold company stocks, you would see rallies of 100% and then drop again another 50 or so. I'm a bit surprised by the rally in gold and specifically how sustainable I think it would be. I think there obviously are some uncertainties which Roy referred to specifically regarding geopolitical tension. And I think some of the central banks globally have been buying gold, specifically on the eastern side. But I'm not too sure that, for example, the US will, for example, escape a recession. And I think because of that uncertainty, in some of investors' back of the mind is still looking to buy some form of protection or insurance. And as a result, perhaps that's also leading to some gold buying. But markets, the world's uncertain amount is difficult. Everyone expected a big recession last year. It didn't happen. We saw the pivot. And now, once again, it seems interest rates are going to remain higher. So it's very, very difficult to predict the market. That's why you need to try to invest for multiple different outcomes instead of trying to position for only one specific outcome, because most likely we'll get it wrong.
Yeah. Okay, well, it is pretty futile, I guess, trying to sift through the tea leaves, as Roy said. So let's get on to stock-specific questions. There's a question on Remgro, actually. And you have seen a recovery in quite a few South African shares, not Remgro. And the question is, please would you ask your wise panel what the reason or reasons are for Remgro's dismal performance of late? Roy, what ails it?
So Remgro did relatively well a year or two ago when they were restructuring their portfolio. Everyone wanted to see them having more unlisted and their strategy coming through where they said they'll be the gateway to these really good assets. Unfortunately, what we've discovered with their more recent results is that they probably overpaid for a lot of those assets. So they had to impair a lot of them, and the discount to NAV is there. And it's not quite clear where the business goes now. What they tried to do was to partner with experts in the industries and to say that we're the financial partner, the experts will run it, but I'm not quite sure they achieved that with Mediclinic. You've seen the whole Distel acquisition. Distel was a fantastic listed business on its own. Now with Heineken and everything, it just looks a whole lot harder to grow. So it's gone from being a well strategically run business to being almost like a lumbering giant. It's not very clear what the whole point of this business is because of exactly what we've seen in this result. And it's very difficult to understand how they're going to grow the cash flows and return cash flows to shareholders. And I think that seems to be what's ailing.
Yeah, I mean, Alex, have you lost faith in Remgro's deal-making ability? Is that essentially what this talks to? Buying assets at too high a price, then having to impair them. I mean, they admitted they made a mistake with Mediclinic. One didn't think that it was a mistake with the Heineken-Distel deal, but that has had a really tough time of late, that company.
Yeah, I think it's probably fair to say that the market is probably giving a bit of a management discount to Remgro at the moment because the capital allocation decisions, as Roy referred to over the last decade, has been quite poor, and it's quite reflected in the share price as well for Remgro. I think there's still a lot of optionality within the portfolio. So, for example, I mean, they can still sell their portfolio stakes in businesses like FirstRand, Discovery, Momentum, even got like almost R1 billion in bets. And then, of course, the more corporate action can happen, for example, on RCL Foods, and we're still waiting for outcome on the CIVH deal with Vodacom. So there's a lot of things that are still happening there. And so I wouldn't write it off. It's probably from a contrarian perspective, right time to start buying it. But you need to see more action from management. I think they've been far too lethargic for my liking. I would like them to be a bit more active. To the credit, they have been a bit more active of late, but as Wes says, the prices they paid hasn't been great. To be fair, I think the Heineken valuation will probably recover. They did give some disclosure on, obviously there was a change in methodology from the last price they paid to DCF, etc. So you'll probably see a bit of recovery there, but I think there are some concerns about a Mediclinic valuation. But at a 50% discount to NAV, you can probably say, okay, let's take a 20% haircut on Mediclinic, do a couple of deals, and you can probably easily still see 20-30% upside. So I would say I'm cautiously optimistic at these levels, but I think the overall investment market has lost faith or patience in the management's ability to execute.
Yeah. Okay. What about a company called CA Sales? And I suppose this was the company spun out of another investment holding company, PSG. So maybe PSG was a bit more aggressive in unbundling the assets and separately listing them, where Remgro went the other way. The viewer says, I've looked at CA Sales. It seems to be a great small cap share. Their last set of results, good, with a small dividend declared. Is this a share to add to a portfolio for medium term? Roy, is this one that you've had a look at lately?
So this is one that I've not looked in great detail, but I've followed. So just a little bit of background. The CA Sales there was a business that the old Imperial had bought that effectively stocked shelves in places like Botswana and neighboring countries there for retailers. So Imperial did the logistics, and these guys were able to stock shelves and make sure inventory was clear and everything of that sort. Then when the business was sold to Imperial, the owners earned out their money, and then PSG approached them and said, listen, maybe we can do this again. And that was how CA Sales was born. So It's a low capital intensity business that deals with retailers. So it's in the consumer economy of Southern African countries. It looks like they're making progress in replicating the original model, and they're doing it in a slow and gradual way. So it's not overly geared. It's not expanding too fast. They just seem to know what they're doing. So it's definitely something to look a lot closer into. But like I said, I'm not very familiar with the numbers as they stand right now. I just remember the last result was quite impressive. They saw some really strong growth, and you can imagine at this point in the cycle for a business such as that to show such growth, I think is testament to management and execution of strategy.
Yeah. Alex, is this one that you maybe look at? And it's quite illiquid, isn't it? So maybe institutionally it's a bit tricky to buy, but for a retail investor, why not?
To be fair, they've done better than I expected to do. So obviously when it came to the market, I had a close look at it. I obviously was aware of the business as well, with the PSG stable. But what spooked me was they had this very ambition of looking to grow acquisitively and to get to a 10 billion market cap. And we've seen so many of these businesses over the years that just does all these acquisitions and it taters out. So I was a bit concerned about that strategy. But so far they've done okay, and the cash flows are good, and so forth. This business is about half the revenues in Botswana, and they've got quite sizable businesses also in Eswatini and Namibia, which is actually bigger than its African business, or quite similar to that. And I think there's still scope to grow. So I think, yes, it does seem like an interesting business from a growth perspective, but yeah, I'll have to do more work on it. But I was a bit concerned about all those acquisitions, and time will tell if it actually will add value or will be write-offs over time.
Yeah, they've had a very rocky start to their listed life, but they have actually been quite a slow and steady performer to the good over the last year on the market. And a very quick question before the break on Discovery, and the viewer wants to know, could the panel give a short yay or nay for both a buy and or hold for the share at today's price of 117 Rand? So, Roy, yes, I suppose your concern, the pros, the cons, and whether you would buy or hold or sell even.
Look, the bank is a very capital-intensive investment that they've gone into. It seems like it's working, but this isn't a group, when you put it all together, that generates a lot of cash. They've got a good name from an innovation perspective and all of that, but maybe they're overreaching. And you remember, at the back of all of this, there's the NHI issue. So if I combine the uncertainty around the NHI, the uncertainty around the cash flows, and the aggressiveness, the aggressive expansion that they've been going into, I'm not sure. I think you give Adrian Go all the credit, and maybe it's more a hold than a buy, but yeah, it's not one that particularly inspires me at this point in time.
Okay. Alex, are you similarly bearish on Discovery? Would you buy it, or if you were a holder of Discovery, would you hang on?
I'm certainly on the bearish camp. I haven't owned a single Discovery share in about 10 years, I would imagine. So for me, Discovery uses exceptionally aggressive actuarial as well as accounting assumptions and applications. In fact, even unusual accounting to some extent. And also got a lot of debt into the business and very little cash generation. And at the same time, they're looking to expand in multi areas globally as well as locally. And I think they're overextending themselves. And for me, I think, it just doesn't make really sense to me. And I think, look at the last set of all the companies reporting IFRS 17, it was clear once again that some of the weaknesses in Discovery, some of the assumptions they use a lot more aggressive. The write-downs they had to take compared to someone like Sanlam, for example, very conservative accounting. So for me, I'm uncomfortable. I think perhaps some of the foreign investors which have been buying aggressively Discovery over the years, not particularly well held by South African investors. I think they perhaps didn't like the IFRS results, and that explains perhaps the weak share price we've seen so far here today.
Yeah, but we've just showed a 5-year chart of Discovery, and really you've lost money in Discovery, and you certainly haven't taken home a fat dividend, going back to the cash flow issues, which is interesting given how regarded Discovery is for innovation, but it's just not kind of panned out in its share price. So neither of you sounds as if you'd be keen buyers at this point. There's a question on Zim's new currency. So it's not particularly a stock-related question, but I'll ask it nonetheless. Is the new gold-backed currency the answer to Zim's woes? Or is it clear that the performance of an economy and the political system will decide the success of countries? Roy, I feel that we know the answer to that question.
The thing about a currency is backed by confidence and credibility. That's basically it. They've come out and said they've got a specific amount of gold and a specific amount of dollars, and this is what they're going to pay. They're only going to print money to cover that. The thing is, in previous years and in previous iterations, their willingness to spend on wages and to just keep printing money is what has brought them down. So it's going to be interesting to see this iteration. The one thing about gold is it severely restricts your ability to do any of this. So effectively what they're trying to do is to peg their credibility on this one commodity. And they're telling the rest of the world, look at us, we promise we'll hold on to this. People will watch. And I think an interesting way to compare this is with regards to the South African currency and with regards to the South African sub. The subs hang its hat on inflation targeting. They've been perceived as hawks. They've moved interest rates to ensure that they preserve the value of the rand. And they've by and large been successful. So you've seen inflation coming down. It's become a lot more, inflation expectations have become a lot more predictable and a lot better managed because they have great credibility. Let's see how much credibility these guys can earn, because they're starting from what I think, politely call a very low base.
Yes, that is polite. And I mean, negative even given the debt, I think the $17 billion of debt that they've defaulted on, which is maybe why their currencies had no credibility. Alex, just on the rand, maybe, are you surprised at the latent strength, relative strength that we're seeing in the currency, in our own currency?
Not really, because the rand was so weak. I think at some stage it needed to have some form of relief rally, and I think we've seen that now. We're reluctant to expect further strengthening until after the elections, but certainly I think the rand probably went too weak. So I'm not too surprised by the few percentage points we've increased there. But yeah, foreigners certainly are sitting on the sidelines, and they're only going to really start buying or selling South Africa post-elections. Yeah.
And hopefully we could give maybe a better indication of what our economic managements will be at that stage. There are a couple of questions on transaction capital and We Buy Cars, different questions, but the first viewer asks, what's the panel's view of transaction capital after the unbundling? And can it advise of the implications of holding transaction capital shares, in the form of margin trading? Okay, I'm not sure if I understand that question, but what happens to these shares after tomorrow? And the related question is, what's your take on the We Buy Cars listing and the exit points? Roy, do you want to take a stab at the transaction capital question?
Okay. So after you get rid of We Buy Cars, transaction capital doesn't get any compensation for that. Those shares all go. What's left is SA Taxis, Newton, and I think a bunch of debt, unless all of that's cleared. Newton's actually a good, solid business. And in this world of high interest rates, there's a big incentive for banks and other financing houses to sell them these debtor books that they factor and that they collect on. So I think that business has some solid potential. What the entire group ends up doing or being, I'm not very clear on, but I think it is on a far better footing than it was previously. We Buy Cars, on the other hand, very interesting concept. They say they're not competitors with the Motors and the CMH, and I tend to agree. They operate in a different spectrum relative to these others. They trade cars that are 8 years and over. They're definitely one of the biggest in that world, and they have some growth. I mean, we've seen quite a bit of growth in recent years, in the last 1 or 2 years. It may plateau. They probably don't need too much more capital, but it will be interesting to see it as a listed company. I think the more important thing for us as market players is we want more listed companies, particularly companies that were brought up by entrepreneurs, fulfilling their dreams and filling a need and filling a niche that the consumer actually wants. Just remember, the thing about cars is that everybody, a lot of people need cars. I mean, the public transport system isn't that good. The lifespan of a car is extending. Cars get traded a lot. So any platform that allows for fluidity and security has value. And I think that's what We Buy Cars is. Yeah. What is unclear is what valuation the market will give them. We will know on Thursday.
Yeah. Alex, your thoughts? I mean, would you look at either We Buy Cars or transaction capital? Would you prefer either? Would you buy both? And also, how would you benchmark? I mean, Roy was talking about, you can't really compare We Buy Cars necessarily to what a CMH or a Motus or even maybe some aspects of Bidvest. I mean, it's kind of its own little unique company.
Yeah, I've got much more interest in We Buy Cars than Newton and SA Taxi. I think Newton by itself would have been okay, but because SA Taxi is still involved and call it the old transaction capital, got no interest in that.
Okay.
But We Buy Cars, I think, is a welcome listing to a market. It's very first to entrepreneur listing, got enormous growth potential. So looking to pretty much double their market cap in the used cars side. And if you think about it, in South Africa, considering how weak the rand economy is, the demand for new cars is going to continue to drop. So older cars will be driven for longer. So I think they've got a key competitive advantage there, and I'll probably continue to do well there. I'm not exactly sure, thinking about the valuation, how it's going to pan out, what the rating is going to be. So that's always a problem with IPOs. That's why a lot of investors still like to sit on the sidelines to see observe how it trades, and then they make a decision down the line. But no doubt, I find the fundamentals of We Buy Cars very interesting. They were a little bit uncertain about what the valuation will be at the moment.
Okay. And Alex, sorry, sticking with you, there's a question specifically directed to you. Roy, I'll obviously ask you too. Your view on Nepi and Shaftesbury at this point, the two property companies.
Yeah, so Nepi is a business we like. It's generates good cash earnings, or distributable earnings is backed by cash, relatively conservative accounting as well, and obviously good growth prospects. You can actually buy Nepi cheaper via Fortress. I think that's important to note. So I think roughly about 7% of Fortress, not more, is actually in Nepi. Okay. So that's a discount into Nepi. So that's something to consider. Shaftesbury, yes, obviously there was the old Capital County that merged with Shaftesbury. So they got its fantastic assets in London. I guess the valuation has always been a bit of concern, but it's certainly world-class assets. They got a lot they can do there to milk those assets a bit higher over time. And obviously, I think the asset growth will be, the distributable growth will be there. So I would say quite positive about Shaftesbury. Not necessarily going to jump at joy to buy it, but I think it's certainly an investment that you can consider.
Okay. Roy, do either of those companies take your fancy?
Look, I definitely hold Nepi in very high regard. Very good distribution of assets, especially from a South African investor perspective. I think broadly from the property sector, however, bond yields are not working in your favor as we speak right now. And I think to get any form of capital appreciation, you would have to have some expectation or confidence that bond yields will come down quite significantly over the short to medium term. So maybe from a valuation, I think both could be stretched. Maybe it's one of those things where you have to watch and see, maybe the price might come down a little bit, and that's where you get an edge.
Okay, yeah, they've actually had quite a good recovery. Roy, sticking with you, your stock pick this evening, what would you be going for?
So just sticking to the topic we had at the beginning, I'm picking Anglo-American for a couple of reasons. If you want to go into commodities right now, it's very difficult to pick a single commodity, because we're at a very early stages in the cycle, if it is an up cycle. So you want a diversified group that's got a solid balance sheet and capital discipline with some generally good cash generation, and that's Anglos. You'll get Platts in that, you get iron ore, you'll get copper as well, which works very well with the just transition and everything. And iron ore and diamonds, there's a whole bunch of them, and a management team that's been recently reconstituted and is very focused on growing value for shareholders and de-risking the balance sheet. So yes, Anglo-American would be my pick for today.
Okay, great. Alex, how about you?
Yes, I'm going for Process or Naspers as well. Some of the viewers that can recall that I've been probably negative about that business over the last year, but recent events have, my opinion has changed. I think the Tencent has probably got good earnings growth from this space. Their share buybacks, they're certainly positive. At the same time, of course, we know Process and Naspers continues to have share buybacks. So I think it's, considering, and also the fact that Chinese valuations are so low and sentiment is so negative. I think it's a very good entry point into it. I've got reservations about China and specifically the Communist Party there and so forth, but I do think the IT sector is different. You should look at it differently compared to the property space in China or the resource space. So as a result, I think good opportunity to, if you haven't entered, not supposed to re-enter it, or perhaps to do a top-up.
Well, you're in very good company, because what did John Maynard Keynes say? He said, when the facts change, I change my mind. So there you go. Alex, Roy, thank you very much for joining us this evening. Good to chat to you both. Alex Duys is from Umthombo Wealth. Roy Mutooni is from Sanlam Investments. And up next, we have The Close. Stay with us.